Great. Thanks for joining us. It's our first webinar of 2024. There's been a lot going on. Interest rates are changing. Inflation's come under control. Naturally, last year, we had a bit of a turbulent year with 12 consecutive interest rate rises. It's been a bit of a up and down roller coaster. Today, I'm joined with Darren Crocker from International Property Finance Group. I've worked as Darren for a number of years. He's got many years experience like myself. We're pretty much veterans in the industry. I've personally been in property investment for 18 years, both in the off-plan new build sector, and we also do whole of market now, so we can source HMOs and different types of commercial property assets, as well as joint ventures with developers. So lots of exciting news today. I'm going to share the screen just to give you a bit of an update on what's happening in the market. Just as by way of introduction, for those of you who don't know me, my name is Dale Anderson. As I mentioned, I've been in UK real estate investment. I'm the managing director of Fabric Property Group. And yes, over the last 2, 3, 4 years, we've built a very good business. We've got a number of consultants and senior strategists who help us with due diligence and sourcing the right investments. So I'm just going to share the screen with you quickly. So today we want to talk about, firstly, what's happening in the UK market and the updated projections in terms of the 5-year Savills residential forecast and what areas we feel may be good for investment. We are, in my opinion, I've been in the property cycle for the last 18 years. And if you haven't seen it, go check out on YouTube. You've got the 18-year property cycle, which of course does allow a period where prices may go up or down depending on inflation, recession, or whatever's going on. I don't think we are anywhere near the recession that we had back in 2007, 2008. But if you count the years, we're almost 18 years into the property cycle. So I believe there's been a sort of a mid-cycle dip. Interest rates are potentially looking to come down later this year, which will bring much relief for people looking to take out a mortgage or remortgage. Naturally, of concern is the current high interest rates, which, of course, if you're taking a mortgage out, will dig into returns. I do believe we are in a more buyer-friendly market. Low interest rates were going on for way too long. We are back to normalized interest rates. So it's very interesting what's happening, and we're very excited for 2024. So we've put this presentation together. Again, won't go into too much detail and bore you. My name's Dale Anderson. You can follow me on LinkedIn. I do keep everybody up to date on regular market news. We take a very data-driven approach, so we are a knowledge-based consultancy. We've been around now for several years. Our main vision is to help build financial stability through property investment and income-generating assets. In 2022, we won an award for the best hybrid real estate agent, property investment agent in the UK, and I was proud to win the Rising Star Leadership Award as well in 2022. So we look for prime locations, areas of regeneration and growth potential, where we feel there's good returns to be made. Places like we've seen it happen in Manchester, Media City, Liverpool, Birmingham. We also have property in smaller towns like Blackpool and Redcar. So it just depends if you, number one, an active investor, a bit more professional, know what you're doing, maybe know the smaller towns and areas better, or number two, a passive investor looking for fully managed investments. We do have a very stringent due diligence process in place, which we're very proud of. So all of our projects have delivered to date. We make sure, number one, the commercial lending is in place. Number two, the developers have good, solid track records. And number three, we do look at things such as the demand and supply. We use data analytics. We've recently started using AI to also help with the data, so we can help our investors make the very best and safest investments. We've got 200 Trustpilot reviews, so we do have 4.9 star rating, and we can show a number of case studies of people who've bought with us. It's gone fairly well, and they're getting their rents, and they're happy with the investments. So go check us out on Trustpilot. With me today, I've got Darren Crocker as my guest from International Property Finance Group. Darren, welcome. Thanks for joining us. And
thank you, Dale.
Yeah, I just wanted to, I guess the big question on everybody's mind is interest rates, and what are we looking at this year with regards to interest and inflation. What is your expectations? What current rates are you achieving? And, what has been your challenges the past year or so? So yeah, I'll hand it over to yourself, Darren.
Thank you, Dale. Hello, everybody. I think, like you've mentioned, the word on people's lips are interest rates. Last year was one of the toughest years I've had in my 24 years of being a consultant, and I've been through recessions. Rates being changed literally on a daily basis, so you never know what a client was actually going to be able to achieve up until the point of the offer. So the good news is, as of today, we have seen the first sub 4% interest rate on a buy to let for a UK national living in the UK on a buy to let. And so sub 4%, that's the Bank of England base rate is only 4%. So lenders are listening. They're understanding that inflation, like Dale was saying, has come down, and they've got a handle on that now. So the Bank of England are now sort of telling us and telling the lenders that they're trying to get the Bank of England around about the 4% mark by the end of the year. So that gives the lenders and brokers, as well as clients and customers, a lot of confidence that if like the government, I'm not going to get into all the politics of it, but the government and the Bank of England and the lenders are actually listening to the fact that people can't have the rates as they were, because it just didn't work. That the process of having rates as low as they did for so long didn't work. A bank and building society in the UK are not charities. They're here to make money. So the way that it used to be and the way that it's going to get back is they give savers to an average about 2% interest rate on their savings, which then lenders will reinvest into mortgage products, and then they charge 4%, between 4 and 5% for borrowing that money, and that's a normal market, and that's potentially what's going to come back in. We're not going to see the likes of 1-2% interest rates, I don't think. I think the average rates are going to be fluctuating between 3.5% and a 4.5% mark, which is fantastic. To be fair, the first lender to come back in with a sub 4, it's not a massive lender. The way, but hopefully that will then start filtering in, so rates will start coming down. Yes, there's a few quirks for lenders to actually achieve such a low rate. The structure of the product is slightly different to the days where the lender will say you can have this rate, your arrangement fee will be 1% or 1.5%, and this is the survey cost. They've structured it now so when somebody takes a loan out, the way that I look at it, and like I said, I've been doing mortgages for 24 years, and one of the reasons why we're sort of aligning with the likes of Fabric is because not only do Fabric do their due diligence, we do internal due diligence on the lenders as well as the client to make sure obviously that fits us. Seems so there's a lot of synergy there. But one of the things that I always look at is not just the headline grabbing rate, is how that product works. So what are the monthly payments on the mortgage? What are the fees associated to it? And then when I present that to the client, it's not just, oh, the rate is sub 4%. Oh, but by the way, you've got to pay this much arrangement fee. I work it all out to work out what the true arrangement fee is going to be. So this sub 4% mark, the arrangement fee is 6%, which, to be fair, is on average about a normal arrangement fee at the moment. And then suddenly it means the lender can look at lending more money, because it is all based on the internal calculation when it comes to how much can a client borrow against a unit, whether that be off plan, whether that be a completed unit, whether that be second-hand, new build. It all solely comes down to the rental figure. How much can the lender lend to a client based on the rental figure? Yes, there are other criteria questions in the background, but we deal with that. But the majority of the lending is based on the rental. So if you've got an interest rate of, say, over the last couple of years, the rate's been 7%, lots of people are realizing they can't borrow as much money as they could do because it doesn't fit the lender's calculation. But now rates are coming down, it means people are borrowing more and more money, which means that people can potentially borrow up to 75% of the property value instead of 65%.
So while I've got you there, quick question. So
yeah,
the last year, interest rates went up unexpectedly. People bought in projects, put deposits on off plan, and all of a sudden interest rates went up. And in the manner of being transparent, as we are, we had some challenges where investors, maybe put a deposit down expecting to get a low rate because rates were so low in 21 during COVID 2022.
Yep.
So what's been the biggest challenge in 2023, and how can investors safeguard themselves against those challenges when it comes to taking out finance?
So with the interest rate, we can explain to a client how they fit with the current interest rate. And we would have done this 2021. But then the way we've managed to sort of find a solution for anybody that maybe bought a property in 2021 and come to completion this year, which there are quite a lot of clients done that off plan, is we then have to either restructure with the lender that we've originally agreed it in principle with, because we can do that pre-completion, regardless of how long it is. We can get the lender to agree to that client, so the client's got full knowledge they're able to get funding. But the way we restructure the solution is it might not be that one lender we've had it agreed with. We will look again 6 months prior to completion and find the right solution for that client at that particular point. Now, what we did find last year was instead of people being able to borrow as much as they thought they could, it meant the lenders that were available potentially would lending a little bit less. So that's and again, we are completely transparent. If we can't find somebody, and we're not tied to a panel of lenders, we are completely independent. We do with every single lender that will lend either in the UK or expats or international buyers buying in the UK. So we will look at every single lender. We'll try and find that solution. Yes, sometimes there will be times when there are no solutions. In that scenario, we have a fund manager or a fund company that at the moment is lending 65%, and they will lend on most projects, and they'll lend solely on the proposal of the property as well as the rental figure. So not so much, but it will be capped at 65%. So there'll always be a solution, but it just might not be. If me personally, I'm sort of saying, if you're buying a new build or buying off plan, 65% really is the benchmark. If you need more than 65% of the property value, then speak to the wealth manager or speak to me first to see whether or not there is any options for that particular point. But that's the way we do it. We'll always try and find a solution for the client.
So a very good point there, Darren, and I do urge caution to investors. We have a stringent process of compliance in place now. I think I showed it to you, Darren, where clients need to be aware that with off plan, you can get a decision in principle, right? That's a decision in principle based on the current property. More so now you're saying on the actual rents and the property itself rather than affordability, which is beneficial with investment property. But things to consider is at the point of completion, what is the rate going to be, and making sure you get the mortgage in time to complete as per the contract. So I think that's quite an important thing, because what we don't want is people putting down 20% deposit, come to completion, they're in a panic, the lenders are slow, things are being downvalued. Now, surveyors have been slightly downvaluing some properties for various reasons, mostly because interest rates have been high and they don't know where the market's going. I think that will change with regards to inflation being down at 3.9% now. It was at a high of 10% a year ago, so I guess they had no choice but to reduce interests. In your mind, when investors buy off plan, what would your process be to mitigate any risk of them not being able to get a mortgage? And what do you expect rates to be at, say, if they buy something completing in 2025?
I think they'll be around about the 4% mark in 2025, subject to nothing else happening within the world. But obviously something always does happen. But yeah, so I think around about the sort of 4.5%. That's sort of a good indication of interest rates in 2025. But what we can do is we get in early. So we have a conversation with the clients. we'll have a video call or a telephone call. We have a small data capture form, as in name, address, telephone number, etc. And then I would then do all my research and then come to you and say, look, as it stands at the minute, this is potentially what you can get.
Okay.
But what we can do then is we can approach that lender to make sure that lender will lend to the client, as in the client situation. Forgo the property.
Right.
It's really, can that client get funding? And then
Okay.
6 months prior to completion of the unit, we'll go back into the market and make sure the client gets the right lender, the right interest rate, the right product at that particular point. And it does, we start 6 months because of delays with solicitors, delays with lenders, delays with surveyors. That's the main thing. There's not enough surveyors to deal with the amount of building work that's happening in the UK. You've got to imagine we're still quite a small island. So,
Yeah.
but it's those things. And if a lender does come back, for instance, and reduces the value of the property for any reason, again, I'll speak to the client, work
Yeah.
out what the lender would do, what the client can do. Part of the due diligence that you mentioned, Dale, is see if
Yeah.
they've got any other funds they can do the top up. If they can't, then we'll just go back to square one again, find a different lender. So until
Right.
there's literally no more lenders. So we'll all, and that's the reason why we say 6 months.
Okay. So good news, interest rates are improving. We are seeing rates. I saw an article earlier with a couple of the rates that have been released, and it looks like we're having some rates. I think Lend Invest 0.80% buy-to-let rates, or slashing rates, CHL as
Yeah.
well, 0.65%. You mentioned Foundation Home Loans, FHL, are doing a fixed term, 5-year fixed term product. Is that sort of what you would recommend, is a 5-year fixed term product now? Or do you think clients should go variable with the hope interest rates come down? And yeah, just tell us a bit about the current products on the market.
So the current products, like I said, the current products are the tracker deals, like you said, Foundation Home Loans, CHL, Land Bay. So these are all lenders for UK nationals in the UK. There are some lenders for expats and international buyers, but their rates don't seem to change as quickly as the UK ones, because there's not so many applications, if you like, against what everybody else can do. But to be fair, when it comes to a product, I know this sounds good, it sound really strange, but when a lender looks at finds how much a client can borrow deal, it's not the rate that you're going to get on a tracker deal. They have to increase it just in case the Bank of England base rate increases again. So you'll find on a tracker deal, on a buy to let, there's not very many variables. It's always tracker deals or fixed 2 or 5. On a 2-year term, with the rates that the lenders are envisaging for 2 years, on a 2-year deal, you'll always be able to borrow a little bit less than you can on a 5-year, because 5 years is a lot more secure. But to be fair, there's benefits of doing a 2-year. There's benefits of doing a 5-year as opposed to 2 years. The main reason is, if you did a 2-year, you think about the difference between a 2-year and a 5 years. If you did a 2-year deal, you've got to pay those fees associated with applying for that mortgage, valuation, potential legal fees, potential arrangement fees, 3 times in a 5-year period. So you've got to incorporate all those fees into it 3 times. And also you've got to see my ugly face every 2 years, which, believe me, you don't want to be doing that.
Yeah.
Whereas if you do a 5-year deal, you've only got to pay the fees once. So, and 6 months prior to the completion, I'll contact you again and just run through the process.
Great. And I'm going to ask one more question for you, Darren. If for example, I'm coming to the end of a fixed term mortgage and I had a great, crazy low borrowing rate of 2% or whatever, what would be your advice?
So again, whenever it comes to an end of a deal, I'll always, if I've spoken to you before, my system and my background stuff will always contact you 6 months prior to the end date, so you're not scrabbling around at the end of it. But if you come to me and said, Darren, my deal finishes in 4 weeks or 6 weeks, what can you do? Then I would say, I would do all my best to try and get you, because what you don't want to do is stay with that one lender and then they put you onto the variable rate. To give you a flavour, the variable rate with some lenders now close to 9%. So you don't want to be doing that. But what we can do is I'll look at the current lender, find out what they will offer to you, and then I will look elsewhere and find out what somebody else would do for you. So it's about just making sure you're not on that higher rate. I would say at the moment, depending on how much you need to borrow against the value of the property, a 2-year deal might be better if it fits the criteria. If it doesn't, just do a 5-year. And because it's not like you're ever going to live in the property, you're doing this as a business. So as long as it makes sense business wise, then it'll always be better on a 5-year.
Okay, great. Cool, Darren. So we don't go over time. We'll move on now from interest rates.
Fantastic.
A couple of notes. Yeah, I did a newsletter. You can see it on my LinkedIn back in December. Inflation's down at 3.9%. Interest rates obviously sticking around 5.25. I hope they will come down soon. Locations in terms of rental data, the Northwest rents went up last year. So where prices have cooled off and we are in more of a buyer's market, it's probably gone down 1-2%. So not this massive 20% house price crash that everyone predicted on YouTube. But yeah, Northwest rents up 7.6%, West Midlands 7.5%, according to the latest rental index. And then prices, Halifax are saying down by 0.5%. Rightmove, they're saying also a 1.5%. So it varies really. London down, but rents on the plus side have gone up around 6 up to 9% with inflation. I'll get back to the presentation, so just bear with me.
While you're doing that, Dale, so the thing with rentals as well, when the interest rate for mortgages are higher and people can't then, they think they can't afford to borrow, or they can't afford to borrow because the affordability with the lenders isn't there, those people are already in their heads thinking, I need to move. So the reason why the rental market's been going increasing is because people then can't buy, so they rent, which is then fueling the rental market. It's always been the same. It's always been the same.
Yeah. So the UK, I mean, there's a fundamental undersupply of housing. We know that the government needs to build 250 to 300,000 houses a year. I think what's happened during COVID, because inflation went up, the cost of build material went up. So one needs to be conscious of pricing, because a lot of like new build off plan, has been affected by build cost, in particular city centres. I get people asking me for apartments in Manchester city centre for, 2 beds for 150,000, and you just can't get that anymore. So we are in a price sensitive market. As you can see from the presentation on the screen, as I mentioned, rents up 8.9%, average asking price 288,000 across the UK. Rental inflation is expected to go up about 18%, according to Savills, across the UK between 2024 and 2028. But again, there's a fundamental undersupply in the UK. And I think that's why a lot of overseas buyers, people who are based in South Africa or Turkey or Middle East, where a lot of our clients come from, of course, there's other concerns, such as the war in the Middle East. There's obviously things happening there. Turkey, they've got their own problems, and South Africa in particular as well. People are looking for a hedge in British pounds in a country which is still economically stable. A lot of their children go and study as well in the UK. So what do house prices look like? According to Savills' latest residential forecast, the 5-year forecast is 2024. They expect around a 1.5% drop, and then you can see in the northeast, Yorkshire. So what that tells me, we're in the mid of a sort of mid-dip cycle where prices are going to drop slightly. But as you can see, 2025 is looking a lot more promising. The West Midlands, for example, 4%, 5%, 6%. So around 20% growth over the next 5 years, according to Savills. And then in terms of location, today I wanted to talk about Birmingham. Birmingham, for us, there's been a lot of activity going on in Manchester, a lot of investments. There has been news of the high-speed rail now. Unfortunately, government plans, as they do, have not gone to plan, and it's not going to Manchester anymore. I mean, you don't need to look at these things. You should look at local demand, supply, and economic factors in terms of investing in rental property. Is there tenant demand? There's no doubt Manchester's certainly had the spotlight the last few years, but I did want to talk about Birmingham, as I do feel it's the second largest city outside of London. It will still hopefully benefit from the high-speed rail unless anything changes. The projections we're looking at in Birmingham are 19.2%. Prices are still considerably affordable, especially if you compare it to London or even Manchester now. There's a huge student population, so we're certainly seeing a lot more interest there. And what's also interesting, not just the high-speed rail at HS2, Curzon Street, that's going to cut the journey time down to, it's around, what, 2 hours now, 1 hour 50 to less than an hour. So that's going to have a significant impact on people who can't afford to live or rent in London. And people are more versatile now to moving and living in other cities that provide, you know, similar infrastructure, nightlife, and everything else. So the 3 points there, you know, we do look at markets where you can get a fairly low entry-level investment, so the prices are priced correctly. We do comparables. We do a huge amount of research into the product before onboarding, and we do ensure that there's high tenant demand. So most of our buildings will be fully occupied within the first few months. To date, I've been involved with well over 50 projects, and many of them have, you know, rented and provided good returns, and rents have gone up over time. In terms of the postcodes, so we've got a new project called Neighbourhood Heights. Just as a bit of a summary, it's 81 boutique 1 and 2 bedroom apartments. Prices start from around 200 up to about 300,000 on average, and it's not in the city centre, but it's priced very well, and it's in an area called the Ladywood Estate. Very significant there is Berkeley Homes have just signed a £2 billion plan to regenerate the whole Ladywood Estate region. So that's going to bring a lot of investments. I mean, Berkeley Homes pretty much built a lot of the stock in London, which did have a very positive impact, and this is their first major regeneration scheme out of Birmingham. So you can go and search that. It's called the Ladywood Regeneration Estate, and that's Neighbourhood Heights, which is a brand new development that we're offering, 81 apartments. So yeah, I do think Birmingham's been overlooked. They have recently had some issues with the council going into administration, but I think that's not uncommon. Apparently this happens, and you know, they have to tidy things up from a political stance. However, from a property and bricks and mortar position, we have dealt with developments in the city. They're occupied on normal lets, they rent very well, and on short-term lets, 80% occupancy. Rates start from around £90 per night. So we're getting on long-term lets about 5-6% net yields, but on Airbnb model, which you can do on these with the limited number of apartments, you can do short-term lets. We use a company called My Property Host, and you can achieve an 8% net yield. It's got 999-year leasehold and very easy access. It's about a 10-minute walk to the city centre, and accessible to the high-speed rail and all the amenities in the city centre. Completion will be Q2 2025, at which time we expect interest rates would have also gone down, and 25% on exchange. We do make sure all our developments, as I said, planning permissions in place, full funding is in place as well, and that we're working with reliable developers with good track records. So this developer is called Regal Property Group. They've just delivered on Bank Towers, which is probably one of the most iconic tower apartment blocks in Birmingham. And this is the next phase within Regal Property Group's portfolio. So there's some of the CGIs. It is in your, it's proper brick built, so it's not that, like, I don't know how to put it, but some of the cladding on the new build doesn't look great these days. It's sort of plastic looking. So I quite like the brick build, and we look at areas, you know, places like Media City in Manchester. We've only, the last 5-6 years, that's transformed massively. Shoreditch in London, Canary Wharf, Liverpool Baltic Triangle. So that's the kind of place where it's becoming a lot of young professionals, students, and tech entrepreneurs moving in there. So good location. That's the Ladywood regeneration area. It talks more about the growth, economic growth and jobs in Birmingham, and exactly what's happening with Berkeley Homes. We will be able to share this as well. So again, JLL also forecasting 19.2% growth over 5 years. Rental forecast around 19.3%. So there is an expected, according to Savills, 20% capital growth opportunity in the city centre. I do feel it's a lot less saturated as well. There's not a huge amount of development going on, which you are finding in the other cities. Although that's not to say Manchester, Liverpool are all still on our list as top investment locations. London's even making a bit of a comeback, but London's still very expensive. And if you're looking for yield, obviously yields are a bit lower. So it really depends on your goals and what you're looking to achieve. So if you just standard lets and get a in, as an example, a one bedroom at 221,000, we're currently offering an early investor discount, £216,000, and you're looking at about £1,000 a month. So we're going to the numbers, that's £12,000 a year. It's 5.4% net. Some companies always quote gross rental. I don't understand that. You want to know what you're getting net at the end of the day. So it's 5.4% net after your management fees and service charge. Short-term lets, according to my property host, at £98 per night. They expect 80% occupancy per year. You are looking at plus in the region of plus 8% net. Along with your 19-20% growth, you could be looking at a 70% return over 5 years, or 44% return on long-term lets. So that's the numbers. We can offer on this particular development, while it's in the early stages of launch, some incentives. As I mentioned before, the way I would look at the market this year is very much sellers are in a position where demand was not what it was before, where if you get a good, number one, either deal directly with the seller, but then they're going to obviously try sell their development portfolio, or number two, use an agent like Fabric where the price is direct. And because we do quite a lot of sales for some of these developers, the approach we will take is find out your goals and requirements. We then come up with a tailored strategy, because not everybody's the same. Some people might know what they want. They want a luxury 2-bed in Manchester. That's great. But a lot of investors, oh, I want an investment property. Okay, what is it for? Is it for retirement? Is it for lifestyle? You're trying to get more time to spend with your family. So you need to really build out a blueprint and a roadmap. And that's something we do, which we believe does give us a unique selling point. We take more of a wealth management approach when it does come to property. And we do have access to a range of different types of investments, not just in Birmingham. We've got clients who've done investments into commercial property with us, retail, asset management. So whilst off-plan and new build is great, there are other arms to the business. But off-plan, I think, you get a new build warranty. It's fully managed. It makes sense for overseas investors. They can put 25% down. They can also, if I understand correctly, Darren, can you just explain, while we're on the subject, a lot of our clients are from overseas, some are from the UK. What's the difference for overseas buyers getting a mortgage? We will do a Q&A at the end, by the way, and I will answer and open up Q&As through the message and chat, and we'll answer some questions. But just while it's fresh on my mind, what's the difference, and can overseas clients get a mortgage, a UK mortgage?
Yeah, they can. Yeah, so overseas expat international buyers, depending on country of residence and nationality, can definitely get mortgages. It's a few more hoops to jump through, as in we're never going to see the person apart from video calls, and the lender's never going to see them. So a bit more due diligence. Things like a lot of countries abroad don't have any postal service. So when it comes to proof and address, which is a main thing to do with anti-money laundering, they ask for things like a letter from your employer to confirm your salary as well as your address. Due to obviously work visas, your employer needs to know where you're living. So that's that bit. Self-employed, again, depending obviously like electric bill or DWA bills if they're in the Middle East, etc. But the process is similar to the UK, really, to the fact that it's the same documentation is potentially needed. There will be a few more questions, as in proof of deposit, where it's come from, a few more questions regarding how the deposit's been built up, etc. But the process is similar. There is one actually plus point of being an expat or an international buyer buying a buy-to-let in the UK. If you're a first-time buyer, first-time landlord, as an expat or an international buyer, you can actually get a mortgage in the UK and a buy-to-let. Whereas if you're in the UK and you're a UK national or an international client living in the UK at the moment, but you're a first-time buyer, It's going to be very, very tricky, as in there's only 2 lenders in the UK that will lend to a first-time buyer, first-time landlord. And it's because if you're in the UK, the lenders are thinking that person is only going to do the buy-to-let to justify, one, doing an interest-only mortgage, and secondly, they can't afford to get a residential mortgage, so they go for the buy-to-let and they move into the property. So it's actually easier as a first-time buyer, first-time landlord being abroad to get a mortgage in the UK. But it's a similar process: ID, bank statements, proof of income, proof of address. That's about it, really. So there won't be high street lenders, bar HSBC, but all the high street lenders don't lend to expats and international buyers anyway. But we've got access to every single expat and every single international buyers, whether it be normal mortgages, whether it be a Sharia compliant offering, whether somebody wants to do it an ethical mortgage, whether they want to do it digitally. We've got it all covered.
Okay, excellent. So obviously Darren can do free consultations for our clients if you are looking to get a mortgage. There's options to do equity release if you want to expand your portfolio. That's another strategy we will go into one of our next webinars. And I think we will be going more into what we think is the right strategy for 2024 to take advantage, because I do believe we are in a exciting time. Everyone was like, oh, interest rates are going up and prices are going to start going down, and getting worried. And I'm like, I'm smiling, and everyone's like, why are you smiling? Because this is the market I enjoy, because I know my buyers, who are my clients, and my investors, who I value, are going to get a better price, and they're not going to get pay an overinflated price. So I'm kind of happy that things are settling a bit. I think we were in a bit of a hyperinflation market, and things are starting to settle. So yeah, in terms of the house price index, Halifax Housing Index, Nationwide Index, we will provide all this information for free. If you require, you just put yes in the chat box, and we can send you the latest housing index. Someone mentioned there Halifax actually recently said prices went up by around 1%. So there's been a few others come out recently saying, so it's very variable. Some are saying a drop of 1 or 2%. Others are saying, you know, everyone has a different opinion, I guess, based on what data they're looking at. So it'll be interesting to see how that develops over time. So we're going to keep everybody fully up to date on what's happening on the UK market. Please do follow our YouTube channel. I do regular news updates as well as LinkedIn. I want to ask if anybody does have any questions, but first, obviously, I just want to run through what they are saying. So Halifax did report plus 0.5%, nationwide plus 1.5% in the northwest and other areas. You've got national trends: Scotland plus 2%, England minus 1.4%, Wales minus 3%. So quite a few good statistics there, which we can provide with everybody. And, you know, the data is good, but at the end of the day, you know, there's only so much you can do really when it comes to property. I think the main thing for me, number one, are in a good location where there's demand. Number two, what type of tenants are you attracting? So you need to go look at the tenant demographic, and there are a lot of platforms you can do this on as well. We've just partnered with a technology company called Landlord, where you can manage your portfolio online. You can also put in a postcode, and it'll tell you exactly what the crime statistics are, what the tenant demand is like. So that's the first thing to do. You need to look at your financials. We will look at property investments at a 60 to 70% loan to value. We will make sure the rent's covering the mortgage. So unless it's cash positive, i.e. we talk about good debt and bad debt, you want a property to be a positive debt asset where whatever finance you're taking, you know, you can sleep at night. You've got a tenant that's paying and covering that. For cash buyers, I do believe we're in a good market for slight negotiation. If you are a cash buyer, not a mortgage buyer, you know, to get a bit of a discount or free furniture or paid legal. So that's something to bear in mind. And us as a company, we will work very hard for our clients to make sure that they do get the best possible deal across various different types of assets in the UK. So if you want to drop your questions in the chat quickly, I will start to answer those. We'll just do a quick 5-minute Q&A. So someone, yeah, Lily, how could we get the recorded webinar link? Yes, absolutely. We'll email it to everybody who registered to attend, along with the recording. Do we provide with assistance with due diligence required for offshore buyers? Absolutely. One of the reasons Fabric Property Group exists as a business is to make sure that offshore buyers are getting the right service, buying at the right price, and most importantly, not buying into projects which put you at risk. Because yes, you might see something a bit cheaper with a great yield, and some developers offering promises of 8 or 9, 10% rent guarantees. But you need to be careful, because you need to look who's paying the rent guarantee. Is it an SPV? Is it even a guarantee? It's usually an assurance from a management company. So, you know, traditionally, the safest investments are your vanilla product, high-end developers, good quality. You're going to pay a slightly higher price maybe than finding something a bit older, but that's a different strategy. That's if you want to be active and you want to refurbish and build and add value, as opposed to just buying something new build that's going to have a good tenant demand and, you know, has good facilities, but not too many facilities, because then your service charge goes up. So personally bought property the last 18 years. My partner's got a portfolio as well, and, you know, we're happy to jump on a call and answer any questions and tell you exactly what we've been through on our journey. Another question now, how do we get a copy of the presentation? Again, we will email you a copy of the presentation. We've also got a new location guide, hotspots for 2024. So my team's been doing a lot of research. We'll let you know which towns and cities we feel would be best for growth. Let me just check if there's any more questions. As an international investor, between investing either in the UK or USA, what will you advise, as I'm equally familiar with both countries? So the old saying goes, I mean, a lot of people will invest closer to home simply because it's what they know. But I think we need to transcend borders when it comes to real estate investment in the current market, because America is a very large country. So there's a lot of housing being built. There is political instability. There is, I mean, the news probably doesn't paint the best picture of what's going on in the world sometimes, but a lot of geopolitical concerns with the USA and the involvement in various things going on in the world. So the UK, in my opinion, it's a smaller island, it's a smaller country, the population's booming, it's an aging population. You don't have like the gun crime and stuff like that you get as well. And, you know, it's safe. And generally and historically, every 10, 15 years, prices have doubled. They also bounce back quite strongly and robustly from the recession of 2009 when it comes to house prices. That's something to consider. Of course, you need to consider your interest rates as well. But from my experience, I have sold property in the USA, Italy, Cape Verde Islands, Brazil, Egypt, and UK I kind of stuck to because it just was more consistent with regards to mid to long-term growth and returns. It's good to get some exposure overseas and diversify as well. The next question, has the HS2 not going to Manchester affected the investments? So it's not going to affect the demand of property in Manchester. It's not going to affect all the other regeneration. I mean, there's this W Residence, which got launched recently. They're selling apartments for £500,000-600,000. It's a fantastic brand. That's the first of its kind in Manchester. So Manchester has its own economy. Manchester has its own young, vibrant population of entrepreneurs that are doing some exceptionally good things. So as a city, the culture and the growth of the city, I don't think will be affected much. However, people did buy on the projectional, not promise, but there was plans to have this high-speed rail to Manchester. That's been scrapped. Certain things are out of our control. Government regulation, you know, government infrastructural plans going pop. And I don't think it will affect the market much, but I do feel the high-speed rail going to Birmingham is a big plus point, simply due to the connectivity into London. Cross fingers that all does go ahead. But from a rental perspective, from demand, we have apartments in Manchester that are performing well and renting. So I don't see that slowing down, and it is still considered the #1 city or northern powerhouse for the northwest of England, in answer to your question. Any more questions? Just checking in the chat. Do you buy landlord properties? I'm not quite sure. I mean, on these properties, yes, you become the landlord. Do we buy properties? Sometimes if we find deals that are distressed or discounted, we will look at buying them. I hope that answers the question. So yeah, that's pretty much it. I mean, we as a company, as I mentioned, you can go check out our Trustpilot. We have a very good team in the UK who do compliance. So every time anyone buys a property with us now, we check the mortgage situation out. We look at the things such as the KYC, which has become quite stringent, the AML. So we make sure all the ID checks and the AML processes are in place. And we believe we work with the best team of solicitors, mortgage advisors, and tax specialists. So you've got a team of experts to hand to help you with your investments. So just get in touch. We can do a free consultation. Our suggestion is if you want to book in a meeting with one of our senior experts, just put yes into the chat, and we can arrange a time and a date, and they can update you on the market, what the best investment strategies we recommend for 2024, and answer any of your questions about the mortgages as well. Can an international student buy property? Yes, you can, if you are over the age of 18, or your parents can nominate you. Some people like to set up some sort of a trust as well. That can be fairly tax efficient. And then what they do is nominate their children at their 18th birthday party. But any overseas investors technically can own a property and register the title deed in their name, but they have to be 18 years old, I believe.
I think maybe that is whether the question is 18 or over, whether it's if a student can buy in the UK. One of the criteria for a few of the lenders is you have to have some form of earned income to be able to service the loan if you haven't got a tenant. So one of the background criteria is some lenders will say we don't need to worry about income. They'll look at the person's situation. So if somebody, say a student, and they're going to graduate in a year's time and they've got the ability to earn enough money, they'll look at that. But most of the lenders will say, especially if an international client, you need to be earning at least £25,000 sterling equivalent, or like I said, you get your parents, you can have your mum or your dad on the application with the student. I'm just doing a Turkish student at the moment where her dad's going on the mortgage with her until the point she graduates. And then once she's graduated, when it comes to the end of the 5 years, when we come to remortgage, we'll just remove him off the application and we'll just start a fresh application for her.
Brilliant. So that answers that question. So yeah, I think we've answered all the questions. As I mentioned, we are offering on Neighbourhood Heights special offer at the moment, including legal fees paid. So if you do want some information, we'll get it across to you. Feel free to get in touch with one of our team. Our team have put in a process as well where we like to get to know your situation as best as possible. You can fill in a purchase form where you put in your requirements, and then what we do from there, we'll actually put you on a Zoom call with one of our directors. We've got 3 directors in the company who can, go into a bit more deep dive into your current situation. We're going to ask you questions you might not like, including what are you doing in life and what's your job and what's your salary. But that way we can really assist putting out a full strategy for you, not just a buy one property, actually a portfolio strategy. So it's an additional service we offer. Not everyone has to take it. Of course, if you're just looking for something very specific and you know what you want, we can help find it. But if you're starting off as a novice investor, I'd highly recommend you book in one of those consultations with the team. So thanks for your time, guys. We will keep you updated lots of news coming out, so we'll keep you fully up to date. Please subscribe. I do have a newsletter as well that you can subscribe to, where I do a lot of data analysis, and then every few weeks I send out all the latest housing data. We'll keep you fully up to date, and we'll keep you up to date on the next webinar. We will have a podcast coming up soon as well, and we will make sure everybody's gets involved in that and signed up. Thank you very much, everybody, for your time and for being here today, taking the time out on your busy schedule. We hope you found that useful, and we hope to hear from you soon. All the best. Take care.